All right, so continuing on with chapter 14 is we're going to be talking about how we can keep track of fixed assets. Now, here's a rule that you need to know. When you purchase or make purchase of fixed assets, so buying things like, for example, furniture, a vehicle, a building, a machine to be able to help you operate your business, that is separate from inventory. Inventory is your process of selling items, right? You buy and resell. Fixed assets are things that help you operate your business. So again, if you have a store, right? You bought the building, you bought the furniture inside there, right? We call fixed assets as the 3 PP&Es, okay? So the first P is property. So that means the land, the sidewalk, the street lamps, the parking lot. If you own all that, that's going to be considered a fixed asset, okay? Plant's going to be the building and everything that's inside it. So lamps, furniture, tables, right? Desks, okay? And then equipment is going to be anything machinery. So if you need a refrigerator, right? That's a machine, right? An ice maker machine, that's a machine, okay? Now, in this case, those are all going to be considered fixed assets. Now, the key thing about fixed assets is they are tangible, okay? You can actually physically touch them. So in this case, when we acquire these fixed assets, right, eventually over time, right, we have two rules that govern this. Number one is going to be the historical cost, which means that the day that you purchase it, you're going to record your books as if that is considered an asset, right? That means you invested in an item. For example, I invested to a couch, right? That means that's going to be something that I own. And then if I trade out for any reason, I trade out my asset, it's going to hold some kind of value to it. But in this case, we also have what's called the matching principle, because in this case, right, what we need to know that when acquiring these fixed assets, eventually over time, as we use the items, right, if we sit on the couch, right, obviously there's wear and tear going along. It's not going to hold its value over time the day that you purchased it, because you're wearing and tearing. So as it gets older and people keep using and sitting on it, then eventually it should lose its value over time. And that's hence the word depreciation will come and rise. Depreciation is going to be a means of a non-cash transaction that allows you to take the value of an asset and depreciate it. So, appreciate means adding value, right? Depreciate means to decrease in value, okay? Now, in this case, it's very complicated, especially if you don't know accounting, to understand how depreciation works and why you can't write it off the actual asset itself. Again, that's more for advanced level of accounting, and also the bare minimum is going to be taught in the accounting class. However, one thing you need to know is that depreciation is what balances out your books, because you need to match it along with the actual asset cost, right? If you bought the asset for $150, that means at the end of its life, it needs to be matched, depreciated $150, okay? So there you go. I just gave you a brief explanation of what happens when you acquire fixed assets. Now, in this case, this is just saying it, but if you're a sole proprietor, this rule does not apply to you. It says that for any assets that are $2,000 and above, you need to record it under your fixed asset list. I say no. Reason being is because again, QuickBooks is more geared towards for a bigger type of company. Okay, it's meant for making it easier to keep track of your income expenses for a bigger type of company that does transactions left and right. So in this case, $2,000 is a bare minimum requirement for you to put in a fixed asset for a typical company. $2,000 is for a sole proprietor is a lot of money. Compared to a corporation, it's nothing. Okay? So in this case, if a fixed asset you think is necessary to put on a fixed asset list, you put it in there regardless of what the price is. But of course, if you buy a $5 trash can, right, is it meaningful to have to put it under a fixed asset list? No. In that case, no. You can justify that saying you can just count that as a mere business expense, right? It's $5. But if it's a machine that's $200, or if it's a, something along the lines of, if it's a printer that's $350, then go ahead and put it in there. Even if it's a coffee machine for $50, put it on there, okay? Because it's going to be considered an asset, okay? Unless you choose to just write it off as an expense, you can go ahead and do that too, okay? But in this case, what is this fixed asset list, okay? Well, in this case, what you have to do is when you acquire those fixed assets, you do need to have an actual fixed asset account. Now, again, how do you set that up? It's straightforward. If you have vehicles, if you have furniture, you would already set those accounts up automatically. Now, again, what does the fixed asset list do? It just expands so you don't have to clutter your fixed assets at all, okay? Or your furniture account, right? You don't have to create sub-accounts saying, I bought a couch, I bought a desk, I bought this, I bought that, right? You can eliminate that and put that on the fixed asset list. However, you still need to have the account that's so associated with it, okay? Just like how items work, right? Items, right, is your sales process, right? It's your means of collecting income. So therefore, are you using an income account? Yes. But are you breaking it down by individually of the items that you sell on the chart of accounts? No. You do that by doing the items. Same thing with payroll items, right? So this is essentially the same thing here. But the key thing that you need to at least have is those fixed asset accounts. So whether you buy a truck, right, that's furniture. If you buy a building or then it's part of land, right? If you buy furniture, then that's part of furniture, right? You need to have the main account there that exists first, and you need to acquire them first. So, for example, if I paid somebody for a truck, right? I'm going to designate that in my vehicles account, all right? And then what I'm going to do is once I've acquired it, that's where I'm going to add it into my fixed asset list because now I need to keep a good track record for it, okay? So let's go ahead and do this example here where we're going to be entering in a vehicle and how we keep track of it, okay? So once again, in this case, we bought a car, right? We bought a Toyota truck, okay? I don't know if it's a Tundra or a Tacoma, one of those trucks, okay? But in this case, I already have a vehicles account. And right now, it is outstanding for $0. So in this case, I don't even have the truck to begin with. So in this case, I do have to acquire it. Maybe I have to go through a business loan or I have to go through et cetera, right? But in this case, if you have it in there already, then that's where you would put it. And there's supposed to be a value in there. However, once you already acquired it, you're going to go to list, okay? And then you have fixed assets list, okay? And once you come here, what you're going to do is now you're going to create the account or create the item for the truck itself, okay? So again, using the fixed asset items list, okay, we are going to do, we're going to add in a company vehicle, okay? So now how do I do that? Again, straightforward, right? We've done this before on lists, right? It's the same exact way, okay? So in this case, I can just right click here on my fixed asset list and be able to just go ahead and, I'm on price levels, my bad. So list, and I'm going to go to fixed assets, okay? Okay, So once again, there's nothing in here. So what I'm going to do is I'm going to go ahead and go down to item, okay? And I'm going to create new. So then now it's going to open up this items list or this window where it allows me to enter in all the information that I need about my fixed asset. So in this case, you do need to have the account already. So in this case, what is the asset name? Okay, the asset name is going to be a company vehicle, okay? Or in this case, it could be the actual product name. So in this case, I can also even put in 2020. Oh, okay, it's a Ford Escape. Okay, Ford Escape. Okay, whichever means that you want to put in there. Now, what is the asset account? So what is it referring to? It's referring to which account is this going to be under, and it's going to be under vehicles. Okay. Now the question is, did you purchase it new or did you purchase it used? In this case, I purchased it used, okay? All right, and what is the vehicle asset? Okay, okay, so in this case, it's a 2020, okay, so what is the product description? Once again, it's a 2020 Ford Escape. Okay, it's used, okay. Select the description. So in this case, let's see what's next. For this case, when was the date that I acquired it? In this case, I acquired this asset on December 15th of 2024. So in this case, I'm just going to make the timer a little relevant here. So I'm going to say December 15th of 2021. Okay. What is the cost of the asset? In this case, it cost me $20,000. Okay. Who did I pay? In this case, I paid National Bank Visa, so I got a loan on it. So National Bank, or not Visa, excuse me, just National Bank. Okay. I bought this in San Jose, so the class is going to be San Jose. Class is going to be Vehicle X. Where is class? Class. Okay, so then now it's saying okay, location, San Jose. Okay. And then now it's asking me for a product number. So PO number is in case if you actually called the manufacturing company to actually order this car, then or order a particular asset, then you could put the PO number there. So in this case right here, what's my serial number? Serial number could be the car manufacturing number on it, the license plate, whatever you want to put in there. So in this case, it is F100. Okay, 1 another F. Wait, hold on. Let's see. It's 1F10011. Okay, 11000. Wait, there's only 2 zeros. 11001. Okay. And anything, if you have a warranty on it, what would you put in there, etc., okay? So once everything looks good, again, you're not going to sell the price at all. But again, if you do plan to sell the car, when you depreciate it, how much is the value going to be sold at the time? Okay, so this all looks good. I put all the information about my truck, and I'm going to go ahead and click Save and Close. So now this is where, when I actually am looking at this is how I'm going to know how much my asset is, and this is how I keep track of it. So in this case, when I depreciate it, right, I need to know how to calculate my depreciation, okay? In this case, QuickBooks is not going to know what to depreciate, okay? So in this case, there's my asset, right? And I'm going to close that out. So now I need to create a general journal for my, to do my, to basically do my depreciation. I need to create a general journal entry. So in this, okay. So again, it's going to still be January. Since I bought it December 21, that means I'm going to depreciate it for its first month for January 31st of 2022. Okay. Okay. What is it going to be here? It's going to say this is 5 now, since we did 2 in between, or 3, 4. I don't know. So in this case, again, journal entries as the first one, right? That's your depreciation. And then now you need to actually create your depreciation account. So in this case, depreciation expense. And then the last one is going to be accumulated depreciation. Okay, so again, you need to create a contra account, which is going to take away from your fixed assets. So again, now I need to figure out what my debit and what my credit is going to be. Well, in this case, there are many, many methods that you can use to depreciate your assets, right? An example is going to be the straight line method. Well, in this case, if I say that my truck is going to last me 7 years, right, and it's worth $20,000, right, and I use straight line, in this case, how am I going to know how much my money is going to be? Well, in this case, they already pre-calculated it for you. So in this case, they've already done the calculation for you already. So in this case, you don't need to necessarily need to know this. But again, if you are planning to depreciate an asset, right, you need to know what method you're going to be using and how you're going to be able to do that. So in this case, calculating depreciation, you need to go to the accountant you could use the accountant menu, which can manage your fixed assets. But in this case, I don't have the accountant's version. I have Premier. So you're going to have to create a general journal for this. And again, you need to calculate how much depreciation you're going to put in here. So in this case, they already assumed that for the month of depreciation, they're going to depreciate it by $125. So again, whether you're using straight line, double declining some of the years, right? Those are all going to be numbers that you are going to be using to reflect your depreciation accordingly. Okay? So again, you would actually have to manually know how to do those methods offside. QuickBooks does not do the depreciation method for you automatically. If you do have the accountant's version, which again, depreciation is for tax purposes only, or not for tax purposes only, but it helps you do your taxes, then you will have the option to use the fixed asset manager. In this case, you just have to need to know which method you're going to be using and physically calculate it here. So if I use the straight line, right, if it's 20,000, I'm going to divide it over its number of useful lives it has. So if my asset's supposed to last me 7 years, I divide it by 7. And because this is a monthly depreciation, I'm going to divide that again by 12 to get me my total depreciation for that month. Okay? So again, there are many, 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 many different methods that you can calculate depreciation. That's just one of them. Again, seek a professional accountant for this, for help if you need to help to understand how depreciation works. So again, I'm going to go ahead and write depreciation for 2020 Ford Escape. Okay? And I'm going to copy this and paste it in all 3 of them for the memo. Okay? Once everything looks good and everything matches on both sides. So again, you got the depreciation expense for 125 and the accumulated depreciation for 125. I can go ahead and save and close. Okay? Then you're going to get this error message right here. You just click OK. All right? So if I go ahead and go into my chart of accounts once again, okay, I'm going to notice this, that the accumulated depreciation is actually something that is an asset, and it tells me that it is at negative 1450 right now, just because there's probably other assets in there that you've depreciated. So again, if I double click on it, here we go. My general journal here for 125 is right here. Okay. So again, that's how depreciation works. Okay. Even though like it doesn't really affect anything else. It doesn't even affect my fixed asset list, right? That's just for you to keep track of what those items are on your list, what kind of assets you have available. Okay, so fixed assets. Okay, so again, I still have my vehicle for $20,000. Okay, nothing else. So in this case, oh, okay. Well, here it says that it is now, yeah, it is still $20,000. So again, your fixed asset list doesn't really necessarily do anything more except for keep your fixed assets organized and so on and so forth. All right. Any questions?
No.
Okay. All right.
No.
All right. So next section that we have is going to be something I'm going to skip over just because it may apply to you, it may not apply to you, okay? And that is processing 1099 workers, okay? So again, is it an option for you to be able to operate your business by having your third-party vendors or people to provide services for you or independent contractors, okay? It is up to you. Is it necessary to have independent contractors? No. If you prefer to have employees, then go refer to chapter 10 and 11, right? But if you don't want to pay these people as your employees, then maybe you should consider having your 1099 workers. In this case, there's a lot of rules and regulations because 1099 workers, you need to go into contract with them. You need to lay out the rules of what their job and task is to do, okay? But remember, the difference between a regular common law worker and an independent contractor is the job is the same. However, the result is going to vary because again, as someone who's working the job for you, you're going to tell them when to do the job, how to do the job, how to complete the job, right? What the task is, and so on and so forth. So you're directing and you're getting the result that you want as an employer, right? That's what an employee does. Where an independent contractor, they get a task done, however means that they get the task done is based on whatever that they do. So that's the difference here is you can tell them what to do, but you can't tell them how to do their job. Okay? You can't tell them, I want this to be done at this time, at this day, in this hour. No. Independent contractors, they do it on their own times, at their own terms, but the only thing that the criteria here is they're getting whatever the job or task is done. Okay? So in this case, so that's the difference between what it is. Now, that's only if you choose to have an independent contractor, which is considered a 1099 worker. You can use a 1099 worker for a third-party vendor. For example, I need someone to deliver my equipment to go to this place. Okay, I'm going to have a third-party vendor or third-party truck delivery services to be able to do that for me. Okay, those could be independent contractors. I can pay a specific person to get something done for me. I can use them as an independent contractor or a 1099 worker. So again, if you do have those type of people in your company, then this section is for you because you do need to process them into your books as a 1099 worker. You need to also file taxes for 1099 workers, okay? Filing taxes meaning you don't pay into their taxes, but you have to give them a 1098 form, all right? A 1098E form, wherever it's called, right? That gives them their taxes that they contributed to your company, right? Because they did services for your company. Okay, so again, you need to be able to file all of those forms. You might have to even file a 1090 form. There's a lot of forms that you have to do in regards to that, and this section will teach you in more regards to that. I'm not going to show this because, again, it may be relevant to you, it may not, okay? So it's going to be subjective based on what your company does and how you want to manage and have your company go through, okay? So the next section is going to be managing your equity, okay? How do we manage my equity? So because as a sole proprietor, your equity is going to be your owner's withdrawal, owner's investments, and owner's equity, okay? Now, in this case, this chapter has all of them, including corporates. They have partnerships and so on and so forth. But here's the one thing that you need to make sure is, does your books, depending on what kind of company you are, you need to have the proper terminology for the correct type of equity you are. So again, if you are a sole proprietor, you have owner's equity. If you are in a partnership, you'll have partnership equity. If you're a corporation, you will have stockholders equity, okay? At the end of the day, they all do the same thing. But for tax purposes only, if you are using QuickBooks to help file taxes for you, you need to have the correct equity accounts. So as you can see, they put in all of them. So as an example to show you what the three different types of organizations are, okay? So you have all of that. Now, what is retained earnings? Retained earnings is going to be a corporate terminology for more or less when you close out your books, okay? Meaning you close out your income and you close out your revenues. Retained earnings is where it's going to be placed at. But in this case, what QuickBooks has done too is they created a retained earnings account, and they also created an open balance equity account. So again, now you're having way too many accounts that are having too many too many accounts that do the same thing. So in this, an open balance equity is when QuickBooks actually closes out the books, which in accounting we learn when we purposely zero out all of our income and zero out all of our expenses, we put in the special account. This is where QuickBooks automatically does it for you. Now, what you need to do here on next is you got to transfer this open ending balance to the retained earnings, and then you're going to close out that retained earnings to the proper account. So, for example, retained earnings for corporations would be common stock, right? Or in this case, stockholders' equity. Okay. So again, for accounting, we learned that for sole proprietors, we have what's called income summary. Income summary, retained earnings are the same. But because they automatically do and process the closing process for you automatically, your income summary is more or less the same thing as your open ending balance in equity. Okay? So that's that there. So what we have to do as a responsibility when we close out our books is we need to select which accounts that we need to move from one account to another. So that's what managing equity does, is that, well, now that I'm closing out my ending period, if I choose to reinvest my money into the company, then I need to move my money from this account into equity. If I choose to pocket my profits, because again, as a sole proprietor, you and the business are one. So if you created a profit, right, that means you have every rights and every means to pocket all of that money. But if you're going to pocket that money, you need to transfer that money into equity, right? And then you need to do an owner's draw from there, okay? So essentially, you're going to be ending up doing the same thing at the end of the day. Now, let's go ahead and take a look at an example of withdrawing from the company so you're able to, be able to do equity for that. So again, at the end of the given accounting period, you do need to close out your account. So in this case, I want to do an owner's draw. Let's do an example of an owner's draw, and then let's do an example of closing out the equity account, okay? So once again, now when I say close out the equity account, I don't mean to zero it out. I mean, what I meant is you're closing out all of your other accounts and putting it or investing it into your equity account. That's what I mean by closing out those accounts to equity. Okay? So first thing I'm going to do here is for this kind of scenario, right, you do need to have a general journal to be able to create this, okay? So in this case, here I am, okay? Again, now it is the same dates here, and let's go ahead and do an owner's draw. So again, journal entries to keep track of it. Now in this case, what I'm going to do is I'm going to do an owner's draw. So again, owner's draw, okay? And where is this going to come out from? It's going to come out from my checking account. You never directly take it out from your equity account. However, because you're pulling money away from your bank account, you're going to be decreasing the value of your company, which is your equity, okay? So in this case, that's what I'm going to do. I'm going to put in that I'm doing owner's withdrawal, and I'm going to take money out. And let's say I'm going to take out $1,500, okay? So I'm going to take that from the owner's draw, and I'm going to take that out from my checking account. So in this case, what I'm going to do here is say owner's draw withdraw. Okay? And I'm going to copy this memo for here, and I'm going to copy it here. All right? Once everything looks good, I'm going to go ahead and save and close. So then now I have taken money out from my company, right? If you go to my owner's draw account, right, it's saying that I have taken $1,500, okay? Now, when you reach the end of the accounting period, right, that means I took money away from my equity, okay? And if I were to do that, then I have to adjust. So in this case, I don't even have an owner's equity account. So in this case, I would have to either create it or I can use opening balance equity, whichever one that you want to choose, right? Because this essentially is the same thing, okay? But you do need to go ahead and I'm going to go ahead and just create that right now, the equity account. So again, it is an equity account, okay? And I'm going to call this owner's equity. Okay, and I'm just going to go ahead and save. This should be account, I don't know. Let me just save it first. So let me see. The account owner's equity should be, we have 30,000, 3,100, 3,200, 3,300. So I have to do maybe 30. I could probably do this as, let me see. I can do this as, let me edit this account. I can do this as 3210. Okay. So there it is. I have an owner's draw, owner's equity, and then I have owner's investment. So once you have this, right, what you're going to do is now when you reach the end of the accounting period, you need to close out all those values into equity, because then now you need to know what the true value of your company is. So they do tell you once you reach the end of the accounting period, you need to transfer all the amounts from the open balance equity account into owner's equity. You're going to take away any owner's draw, and you're going to add any owner's investment to get the true value of your company. So again, the opening balance equity is going to be your usually net income, net profit, net loss. Okay, so if you sold a bunch of stuff and you gain money out of it and you choose to reinvest it into your company, then that's why you have to close it out here. But you have the means to also take away the money from the company as well. Okay, I'm not going to spend too much time on that because once again, it's just another journal entry. Okay, and that's pretty much it. Okay, any questions there? Okay.
No.
No questions?
No, not from me then.
Okay. So now let's go ahead. So again, you guys can just read along what you need to do. In this case, it shows you what to do when you are closing those books out. So here you go. Next section is going to be actually properly closing out the books. So once you reach the end of your accounting cycle, okay? So that means, accounting period, right? So that could be determined, right? You have the obligations to, or you have the options to choose from closing your books every day, every week, at the end of the month. Generally, rule of thumb, most companies do it at the end of the month. Most companies also do it every quarter. And for sure, for the purposes of the IRS and tax purposes, you need to close your accounting books every year. Okay? That's for sure. But you can have a means to break it down so it makes it that much more manageable instead of waiting until the end of the year to be able to do all your last minute adjustments. You can take the time to do it. You can break up the accounting period accordingly for your business. So again, a typical one is usually at the end of the month, right? That way, the purpose of closing out your accounting books is to measure the progress of your business, okay? Especially because when you close out your books, what are the necessary steps that you need to do? And that's where these 10 steps, or in this 11 steps, are going to be. So first one is going to be you're going to be recording any cash, credit card, and loans accounts with the period ending statement. So again, you're going to run a statement, okay? You're going to be entering depreciation, right? You're going to do your adjustment entries, okay? Other than that, if you have some inventory, you're going to adjust your inventory, okay? We know how to do that, chapter 8. Okay. Number 4 says you are using the accountant's version. Okay, if you are, then you're going to be needing to do this. But again, you can also change the accounting or the classes, right? Rearrange whatever you need to categorize, whatever you need to do. Okay, so just to clean up your files just a bit better. Okay. And then number 5, if you are on the accrual basis, right, you're going to run your reports and your revenues. Okay, ask your accountant if you need to. Okay, step 6, okay, you're going to close your equity account. So again, exactly what I just explained about in the previous section. And of course, number 7, you're going to run your reports, which we learned in chapter 6. So what are the 3 financial statements that you need to run in QuickBooks, right? You need to do your statement of cash flows, your profit and loss, and your balance sheet, okay? Other than that, you need to also print PDF versions of the following reports, which is the ones I just listed out, okay? So you need to run other reports such as your trial balance, your general ledger accounts, any other reports that is necessary, okay? Number 9, you're going to back up your file. And then number 10, you're going to set the closing date. And then last but not least, you're going to condense your files. So again, Step 11 is only necessary unless you feel that it's necessary. Now, this is assuming that you are at the end of your accounting period, which is going to be the end of the year. Then, yes, that is definitely something you should consider doing. But again, it is optional because the number one thing that you need to do before deleting all your transactions is number 9, which is to back up your file. Okay, so I'm going to show you steps 9 through 9 and 10. 11 is optional, but I can show you what you can do for step 11. Okay, so closing equity accounts, we already talked about that. What you're going to do is you're going to do a general journal entry, and you're going to zero out your accounts from this account to another. Now, as I mentioned before, right, in accounting class, we have to manually close out all of our income and all of our expenses out to an account called income summary. As I've mentioned to you guys before, you guys already have that done for you automatically, and it is put into your opening balance equity. Okay, automatically. You don't even need to transfer anything information at all. Okay? However, once you've already done that, then you're going to transfer the amount from your income summary into your owners with equity because you are adjusting the value of your company. You're adding value to your company. Okay? And again, you need to close out your owner's draw as well as any investments that you have done throughout the given accounting period. Okay? So that's straightforward. You can use a general journal entry for that. Okay? Once you've done that, which is step 8, okay, so now step 9 is to actually back up your company. Okay? So let's go ahead and back up your company. So let's go ahead and do that example. So as I've mentioned this way back when in chapter 1, I told you I was going to show you how you can create a backup company. Okay? Or create up a company backup file. Okay? So in this case, I go to File, all right? And I'm going to go ahead and either choose, either create a copy, or I can choose to back up the company, okay? So if I create that, I'm going to go ahead and choose a local backup or create a local backup. So then now you're going to get this window, okay? This window is going to tell me, okay, you want to create a local backup. Where do you want to save it? Okay, that's the next thing that you're going to do is where are you going to save it? How often do you want to create backups? What do you want to do? Do you want to secure these backups? Okay, so in this case, I need to find the location to where I want to back up my file. So in this case, I'm going to select the same folder that I created for this class. So it's going to be LVPTA, under Accounting, under QuickBooks, under QuickBooks Portable Files. Okay, and I'm going to back it up right here in AM QuickBooks 131. And I'm going to click OK. So now I designated a location for where I want my backup to be. Okay. Now the next thing says add a date on it. Yes, so then you know exactly which data file it is or which is the most recent backup data file, okay, because it's going to have the date and the time on it, okay? Am I going to limit the amount of backups in one folder? And I can say, well, I want 3 to only happen in one folder, okay? You can have as maximum as 20 in a folder, okay? Whatever means that you want to have. Now, in this case, I'm just going to leave it at 3, okay? Then it says, well, how do you want to save and how often do you want to have QuickBooks remind you every time to back up your file, okay? So in this case, I could do it 4 times when I close my company file. In this case, I could say I want it to ask me every single time I close my file, okay? And then do I want to complete it with a verification? It is optional for you. I'm going to say no verification. Okay? And I'm going to click OK. So again, it tells you that it says, oh, I can't, okay. Use this location. Okay, so I overrided it. So then now the option is, do I want to back it up now or do I want to do it later? And I can schedule when I want it later, or I can save it till the very end when I close out my books. Okay. So in this case, I'll say only schedule for future backups. Okay. Or let's save it now. Okay. Save it now. And I'm going to go ahead and click next. So again, it's choosing my location, right? This is the location I wanted it in, which is our AM file. And check this out. It has the date on it, so February 23rd, and it has the exact timestamp of when this happened, which is 11:08. And I'm going to click save. Okay, so it creates the backup file. It's creating a copy of the file. So then the next time that I need to, for any reason, need to edit any information, I can have the backup file be able to do it. Okay, so that's how I create a backup file. Okay, step 9 says now we need to set the closing date. What does the closing date do? The closing date will lock the data file. Okay. Important thing you need to know here is if you choose to select a closing date, why do you need to lock up your file? Okay? This is very, very, very important, especially when the accounting period is over. You don't want anybody to go into that file or have access to that file and be able to manipulate the financial information. Okay? Again, we call that cooking the books, right? We call that fraud, right? We call that someone who's trying to do fraudulent charges by adding and making changes to a financial information that's already in the past, okay? So that's why we have a preventative measure to do that, and only the accountant is able to lock the file, okay? Only the accountant has access to be able to process something that's in a closed accounting period, right? Because they are the ones that's locking up the file. That means they're the only ones that know what the password is. Okay? So in this case, how do I set a closing date? Now, in this case, this was actually one of the questions when you did the Easy Step interview, was to set a closing date. We chose to skip it, right? So what does the closing date, how do you set it now? Straightforward. You can go to company, right? And you can choose set closing date, okay? Right? It's going to take you to your preferences, and it's going to take you to the accountant preferences under company, and it's going to give you this bottom half right here on setting up a closing date. So in this case, I'm going to choose set closing date, and you're going to get this window here, which basically says, when do you want to close the date? If I choose last year, that means I will lock my file right now, okay? But in this case, I'm going to say, so I'll give you an example. If you lock it up, that means you won't be able to edit the information at all. So if I choose December 31st, which is the end of that year, right? And I say I want to choose my password. So in this case, it will not let you secure it if the password is too weak, okay? So in this case, it's going to be capital A, B, C, D, 1, 2, 3, 4, exclamation point, okay? All right, that should be a secure enough password for this, okay? Capital A, B, C, D, 1, 2, 3, 4, exclamation point, okay? And once I have that, I can click OK. So then once I set my date and I go ahead and click OK one more time, that means if I try to enter in a transaction in a closing accounting, so if I say Bob Mason, okay, so Bob Mason bought something in December 14, okay? And let's say he bought some photo paper, okay? Maybe he bought 10 of them, I don't know, right? If I were to go ahead and save and close, here where it stops you, it says, hey, this is a closed accounting period. What is the password if you choose to make changes to this form? So this is why it's so important that you do this for the end of your accounting period, because again, this is saying, well, I'm trying to impersonate Bob Mason and get these services for myself. I can't do that because I need the password. Okay, but obviously I'm the one that is the admin. I created this, so in this case I can validate it if I need to. Okay, but I'm going to click cancel. So that's the important thing, is that you want to lock up your data file to prevent any fraudulent charges to be entered in after the closing date. Okay, any questions in regards to setting a closing date?
No.
Okay, so as I promised, the last thing I'm going to do here is going to show you how to use the condensed data. So if I say I want to get rid of all of these transactions here, so if I go to File, I go to Utilities, and I use condensed data, okay? It's going to tell you, okay, first, before you condense it, make sure you back up your file. So in this case, I'm going to choose the best option here, which is going to remove all the transactions that you selected from your company, okay? And I'm going to click next. So now it's going to tell me, okay, well, did you already so before a specific date? Yes. So this is what I was telling you, right? You can delete up to a certain point. So in this case, I want to delete all transactions before. So if I want to say I want it before any transactions before December 31st of last year, okay? Or I mean 2020, right? That means anything that's going to be from 2019 to 2020 is all going to be gone. However, all the information that I have for 2021 all the way to 2022 is going to stay in your books. So once again, you can set parameters of how much detail you want to delete. It's not like when you select delete all transactions, it's going to get rid of everything, okay? So in that case, that's what you do, and then you can go ahead and click this. If you want to choose to delete everything and just get rid of everything because maybe you messed up somewhere along the lines and need to redo and re-enter in all your transactions from scratch, then go ahead and click all transactions. But yes, you can delete up to a certain point, and I'm going to click next. So once you've done that, okay, I think I need to, okay, all right, there are no transactions. Oh, okay. Well, since there's no transactions before that, then I need to say transactions for 2021 because I did a lot, right? And I click next. And then, of course, I'm going to summarize all that and so on and so forth. Okay. So then it's going to tell me what do I want to do. Do I want to do unclassified things, transactions, and so on and so forth. I click next, and then it's going to say, do I want to after condensing, do you want to remove unused list entries? So again, if I enter in things in here, whether it's under an account or a customer, I'm going to say yes. Okay, and then once you get there, then you go ahead and begin condense. Okay, and yes, so it's going to get rid of everything. And now because you're in the close accounting period, you need to put the password in here. So A, B, C, D, 1, 2, 3, 4, exclamation point. So there you go. Now it's deleting all the transactions right now, and that is it. Okay, so that means you open up this file. Right now it's closed. So, yeah, all right. Any questions in regards to chapter 14? What are the necessary year-end procedures and adjustments that you need to do to complete your company file? Any questions?
No.
Okay. So again, when you do end up closing your accounting period, please go through all these 11 steps here. I mean, you don't have to do the 11th step, but at least follow through with the first 10, okay? Make sure that you do know what you're doing. Again, this is meant for the accountant itself, not necessarily someone who's a sales representative or so on and so forth, that accounts payable, right? This is for the actual accountant themselves, okay? All right, so let's go ahead and go over the review questions, multiple choice. So your obligation is to select the best answer for each of the following, okay? Number 1, okay, which of the following tasks does QuickBooks perform automatically at year end?
Is it C?
Letter C is correct, right? It adjusts the balance in the retained earnings account to reflect it into the income or losses for the year is correct. Okay. Number 2, okay, entering a date in the closing date field, okay, accomplishes which of the following?
C.
C, it locks the data file so that no unauthorized users can add, delete, or make any changes to an existing transaction. Okay, good. Number 3, avoiding and deleting transactions both do the following.
C.
Letter C is correct. It zeroes out the debits and credits, okay, specified by the transaction, okay? So in this case, we're looking at what both a voiding and deleting a transaction can do. So let's take a look at A. Keep a record of dates, numbers, and details of the transaction. That one is only available for voiding a transaction, right? Deleting removes it completely. So then that's where B comes into play. It says completely remove all transactions as if it doesn't exist. That is only what deleting can do, right? Voiding doesn't do that. Okay? So we're looking for what they both do. And in this case, they both zero out the debits and credits. But again, one transaction, if it's linked to too many accounts, you can have a little trouble there. Okay? All right. Number 4. Okay? To make an adjustment to items as well as their associated accounts, create a what?
C.
C, $0 check. Yes. Okay. Remember, $0 check only allows you to be able to do items and accounts. Okay. A general journal is strictly only accounts. Okay. So that's the difference between a journal and a $0 check. Okay. Number 5, okay, at the end of the year, you should perform the following.
D.
Mm-hmm. You need to perform all of the above, right? You need to enter depreciation entries. You need to perform a physical inventory, right? That's part of I think section think section 3 or 2, one of those. So if you remember that 11 steps when closing out your accounting period, that's one of the steps, right? You need to run a physical inventory account and you need to adjust inventory accordingly. All right, and then letter C says if your business is a partnership, enter in a general journal to enter in the distributes between the profits to each partner. Yes. Okay. So again, D, all of the above is correct. Okay. Number 6 says, okay, to track payments, okay, to an 1099 vendor, okay, and print forms 1099 accurately, okay, you must complete all of the following except, okay, so everything except
B.
B as in boy.
Yes.
Anybody? D as in David?
Yeah, D dog.
Okay, so number 6, the correct answer is letter B. Okay, so let's take a look at this. Okay. All right, so A says set your preferences to track accounts linked to 1099 workers. Yes, that is going to be one of those things, right, that you can do. It just depends on what that job entails. But yet there is an option in there for specific accounts that you can link them to 1099 contract workers. So, for example, an expense account, you can link it to a 1099 worker. Okay. B says enter in the vendor's account number, okay, on the address info tab. In this case, on the address tab, is there an actual account number? No, that's going to be setting up the pay process. Okay, so in this case, B does not exist. Okay, let's see what C says. Select the vendors eligible for 1099 on the additional info tab. So if you remember, this was in chapter 4. We did enter in Boswell Consulting. That was one of the things that for tax info, okay, under tax info, when you put in their tax ID number or their social security number, there is a section where you can check mark the 1099 window, okay? And then letter D says enter in the 1099 vendor's name on the address info tab. Yes, right? You would have to have the vendor's name, which is going to be on the very first, which is the address tab. So in this case, D is the very first thing that you need to enter in is who is your vendor? Who is your vendor? Where are you billing them this bill to? Or where are you receiving this bill from? All right. So again, everything is correct except for B. You do not have the account number in the address tab. You have that under the payment tab. Okay. Number 7, the IRS may reject a 1099 if you submit it. The IRS may reject the 1099 you submit if,
C.
let's see, letter C, number 7 is correct, okay? If the taxpayer ID is incorrect. Yes, so again, with independent contractors, they can have the choice. Usually, most likely, 1099 workers are not going to have their own separate business tax ID number, right? Most likely, if it is an independent contractor working for you, they use their own social security number. So again, the taxpayer ID number is going to be one of the things that has to be correct in order for you to process taxes for a 1099 worker. Okay. Number 9, okay, by creating a special bank account called journal entries, Okay, good, right? You can see all the journal entries in an account register, okay? And it provides you to enter in journal entries at the top of each journal entry. That's correct, okay? So again, I showed you that. That's the purpose of creating one. If you choose not to use this method, that is okay. QuickBooks only recommends it to you because you will be making adjustments throughout your years. You don't necessarily need to create a journal entries bank account. You can have it as a non-posting register at the bottom of your chart of accounts. So, but just to make it easier on you, right? It's just easier to do that so then you can easily locate it a lot quicker. Okay. Number 9, okay? When you purchase a fixed asset, you should code the purchase to
A.
the fixed asset type account. Yes, again, we have the fixed asset list for a reason. Is if you do purchase a fixed asset and you want to keep track of it, then create a list for it. Okay. Number 10, okay, which of the following is not true about 1099s? So again, not true.
B.
B as in boy says you only need to submit forms to vendors who receive more than $600. Is that true? Yes, that is true. Okay. Okay. You only need to submit forms for vendors who receive more than $600 because again, if you're contractually based on this, again, that's for tax purposes. You need to report that on their 1099. So that is true. Okay.
Is it C?
Number 10, yes, it is C. The 1099 wizard helps you properly process 1099 MSI, which is miscellaneous. Or sorry, MI, miscellaneous. 1099 INT, and then of course the 1099 DIV forms. No, you need to manually do those themselves. And where do you find that? In that small section for the 1099, what you do when you process them, it shows you how to process those files yourself. But no, the 1099 wizard does not do that for you automatically. Okay. Number 11, which of the following is an example of a fixed asset?
A.
A $5,000 high-speed copier. Yes, okay. A $2,000 laptop computer and a box of paper. So again, a box of paper is going to be considered like a supply. It wouldn't necessarily be a fixed asset. However, remember, in this case, they say that the rules here for entering in something as a fixed asset would be $2,000 and more. In this case, a $2,000 laptop is for a sole proprietor definitely going to be considered a fixed asset. So again, you have to look in aspects. Okay, this program is more meant for corporations. As you can see, when we enter in our very first company, it was a corporation. So that's just corporation rules. Is anything less than $2,000 is not considered a fixed asset. Which in this case, depending if you are a sole proprietor, anything and everything is a fixed asset, whether regardless of the price. Okay, but again, if it's a $5 trash can, you may want to reconsider that as a fixed asset. Okay, that could be easily set as an expense. You don't need to record or depreciate a $5 trash can. Okay, we call that materiality. It's not worth it to record a $5 trash can, but it's definitely worth it to record a $2,000 laptop. Okay. All right. So in this case, in the standpoint or in the eyes of what kind of company you are, I believe both A and B is the correct answer, just depending on what it is. But if you're following by the book's terminologies and what the book says a fixed asset is, which is anything above $2,000, then A is the correct answer. Okay. Number 12, which is the last question of the day, which of the following is false?
A.
Let's take a look at A, okay? General journal entries do not allow you to reallocate transactions from one class to another. That is true, right? If you go way back to the very first page where you look at what you can do with the general journal, right? The second one is to recategorize based on class. So A is true.
Oh.
Is it C?
C is correct. General journal entries are used to reassociate funds from an item to another item, right? We cannot ever use general journals for items, right? That's only a $0 check has the capabilities of doing it. So in this case, letter C is 100% false, okay? And everything else is true, okay? All right. All right, so that is it for chapter 14. Any other extra questions?